Hey class. Well, I have good news and I have bad news. The bad news is that I still haven't been able to figure out why my camera on my screencasting software is upside down. But the good news is that I think I found a workaround. What do you think?
We recently looked at several different measures of profitability and efficiency that are typically used to analyze companies' performance, such as ROA, ROE, asset turnover, and net profit margin. In this video, we're going to look at how we can put these various measures together. And our starting point is that ROE is equal to net income divided by average stockholders' equity. How much income can be produced from the stockholders' investment in the company? This is one of the primary metrics used by stockholders to see how well their investment has been performing. So ROE is higher when there is more debt or total liabilities. In this class, we're saying that debt is equal to total liabilities, more debt and less equity for a given level of assets and income. This is because the denominator, which we see average stockholders' equity or simply equity, is smaller. But there's a trade-off. More debt means a higher risk of bankruptcy. We can look at the impact of financial leverage on ROE with the following formula. So instead of just simply saying net income divided by stockholders' equity, we can look at the amount of net income that's produced from the investment in the company's total assets, or since net income is a period of time, we should more appropriately use the denominator average total assets. How much income is being generated from those assets? And we know that there's a name for this formula. This formula is return on assets, or ROA. We can multiply ROA times, our numerator is going to be average total assets, and our denominator is going to be average total stockholders' equity. Right, so if we cancel out the average total assets, what do we have is net income over stockholders' equity. That's our formula for ROE. And we've seen this formula, average total assets divided by average stockholders' equity. This is called financial leverage. Remember, financial leverage looks at how much liabilities is the company using to finance its assets. And as you'll notice here, there's no liabilities or debt in this formula. But if we notice that assets can be financed by one of two things, equity or liabilities, we don't need to put liabilities in this. If we look at the relationship between assets and stockholders' equity, it tells us something about how much liabilities are being used. So let's look at each one of these two components, or we can consider ROE as being a function of two different levers or drivers, ROA and financial leverage. Let's start with ROA and quickly review it. ROA measures the return from the perspective of the entire company, not just the common stockholders or the stockholders. This differs from ROE, which is from the perspective only of the stockholders. To earn a high return on assets, the company must be profitable. Right? In the numerator, we have net income. And it must manage the size of its denominator, manage the size of its asset investment. And now let's look a little bit more closely at financial leverage. Financial leverage measures the degree to which the company finances its assets with debt, or more specifically, liabilities, versus equity. An increase in financial leverage implies an increase in the relative use of debt, or let's say technically use of liabilities. And so let's just see where these numbers come from. How do we make financial leverage a little bit more meaningful? So we have our accounting equation, assets equals liabilities plus equity. Let's look at two different companies. So let's say company one, and we also have company two, and they both have $100 worth of assets. The difference is how these two companies finance these assets. Company one uses a 50-50 mix of liabilities and equity. So what would that mean for its financial leverage? Assets divided by stockholders' equity. Financial leverage for company one would be 2. Assets are twice as big as stockholders' equity. Now let's say company 2 uses $75 of liabilities, so more, so we should see a higher leverage, more liabilities than equity, only $25 in equity. So what would this look like? 100 divided by 25, and we would see a higher leverage amount. So even though we don't have liabilities in here, just by looking at the relationship between assets and equity, the higher that relationship, the greater the use of debt or liabilities. Return on assets is a function of 2 separate drivers, profitability and productivity. So we can break down ROA even further. We can look at return on assets as net income divided by sales revenue. And we've seen this measure before. This is called profit margin or net profit margin. Profit margin multiplied by, and our numerator is sales, and our denominator is average total assets. And we can see that sales would cancel out. What we would be left with is net income over average total assets. But the reason we want to look at this broken down is to look at profit margin as one lever, and we know the name for sales over average total assets. That's asset turnover as another lever or another driver. Briefly write some notes on these 2 different drivers. Profit margin, or typically we call it net profit margin. Profit margin measures what the company earns as net income on each dollar of sales revenue, and asset turnover measures the sales revenue generated from each dollar invested in average total assets. So if we put this all together, we can break down ROE into 3 drivers. We can look at ROE as a function of profit margin, how profitable those sales are, multiplied by asset turnover, how efficient are our assets at generating sales, and from earlier, the financial leverage. And this allows the analyst or the manager, when looking at ROE, to really identify where might our weaknesses be, where might we be able to improve. Let's work through an example comparing the different ROE drivers for Coca-Cola and Pepsi for the most recent fiscal year ends. So I've given you the data here. There's also an Excel file if you'd rather work this in Excel. I prefer to do this here so I can write out some formulas. We have revenue and income for the 2 most recent year ends, and then asset stockholders equity for the 2 most recent year ends so that we can use the average balances that we see here. Let's start with profit margin. Our profit margin, as we said, is equal to net income divided by sales. So for Coca-Cola, this would mean 9542 divided by 43004. This works out to be 22.2%. For Pepsi, net income 8910, sales revenue 86392. And so if you just look at these numbers, it's pretty interesting. The net income numbers are quite close, but look at that difference in sales. Pepsi's sales are about twice as high, more than twice as high as Coca-Cola's sales, and yet Pepsi's net income is lower. So what does that mean? Pepsi is earning a lot of sales dollars, but it's not controlling its expenses as much. It's giving away a lot of the sales dollars as expenses. We don't know cost of goods sold, operating expenses, or non-operating expenses from this analysis, but of course we can investigate that further if we wanted to. And we see that here. Pepsi's profit margin is significantly lower than Coke's. So the company with a higher profit margin was Coke. Its sales were more profitable, and it was better at controlling its expenses compared to Pepsi. Its profit margin of 22.2% means that for every dollar as sales revenue, 22 cents or 22.2 cents remain as net income. Now let's look at asset turnover. Our asset turnover is equal to our sales divided by our average total assets. For Coke, we have our sales 43004 and average total assets I see here 93559. For asset turnover, for most companies, asset turnover is going to be greater than 1, and we interpret asset turnover to be a number of times that our sales exceeded our average total assets. So here we see obviously the number is going to be less than 1. We can put a percentage on that, but typically we don't. Just standard convention, because it's usually greater than 1, is just to say 0.46. And what we would interpret this is that for every dollar invested in assets, about 50 cents of sales is being generated. And let's look at how that compares to Pepsi. Pepsi has sales of 86392, much higher than Coke. But assets are about the same. Average total assets 92,187. And this works out to, and while we could say 94%, typically we would say 0.94. And our interpretation here, the company with a higher asset turnover clearly is Pepsi. So now we have a war going on here, right? We have Coke with its much higher profit margin and Pepsi with its much higher asset turnover. So we need to do the next step of ROA to figure out which one is going to win this war, this battle here. Pepsi's assets were used more efficiently because they were better at generating sales. Revenue. Its asset turnover of 0.94 means that for every dollar invested in assets, the company generated 94 cents in sales revenue. And now let's look at ROA as a function of these two levers or two drivers. We're going to look at this as profit margin times asset turnover. So for Coke, this would mean 22.2% times 0.46. And this is going to work out to be, with returns, we typically use a percentage sign. So we can say 10.2% is the return on assets for Coke. And for Pepsi, we're going to multiply 10.3% times asset turnover of 0.94. And that's going to give us 9.7%. So we see who won this battle here. The company with a higher ROA was Coke. And the main driver of that was because Coke had the higher profit margin. So the higher profit margin beat out the lower asset turnover in this case. This is mathematical, so it might not always work out that way. Let's look at our next driver, financial leverage. Financial leverage, average total assets divided by average total stockholders' equity. Now let's look at this for Coke. For Coke, we have average assets 93,559 divided by equity 23,552. And this works out to be 3.97. So what we're saying is assets are about 4 times greater than equity. And how about for for Pepsi? We have average assets of 92282 and average equity of 16596. This works out to be 5.56. So we would say Pepsi's assets are about 5.5 times greater than its equity. So which company used more liabilities to finance its assets? Clearly that's going to be Pepsi. Now let's look at our ROE to finish up. ROE is as a function of ROA times leverage, financial leverage. We have Coke with ROA of 10.2% times the financial leverage of 3.97. And this gives us ROE of 40.5%. All right, so we have this other battle again, right? Coke has higher ROA, but lower financial leverage. Which one is going to win out? Pepsi's ROA 9.7%, and look how much higher this leverage is, 5.56. So the ROA is so close, but the leverage for Pepsi is much higher. This is going to work out to be 53.9%. So what's our takeaway here? Even though Coke had a higher return on assets, this use of leverage, so the ROA is great looking at the company as a whole, but this use of leverage by the stockholders, minimizing the amount the stockholders had to put in and using those borrowed funds, ended up with a return on equity being significantly higher. So the company with the higher ROE was clearly Pepsi, and the main driver was the use of financial leverage.